I'm going to show you how the wealthiest Americans legally reduce their tax bills to nearly zero, not through evasion, but through design. The United States tax code contains roughly 70,000 pages of rules, exemptions, and provisions. Most wage earners interact with maybe a dozen of those pages. The wealthy interact with hundreds. What looks like tax avoidance is often just tax planning, strategies written into law, available to anyone with enough assets to make them worthwhile. So here's how it works. The first thing to understand is that the tax code treats income and wealth completely differently. If you earn a salary, that's ordinary income, taxed at rates up to 37% federally. But if you own assets that appreciate, stocks, real estate, businesses, you don't pay taxes on that growth until you sell. That's called unrealized gains, and the IRS doesn't touch it. A CEO with $1 billion stock portfolio pays zero tax on that wealth as long as it stays invested. What matters isn't how much you have, but how you access it. Jeff Bezos reported a salary of about $81,000 in recent years, less than many mid-level managers. His wealth grew by billions, but almost none of that triggered a tax event. Capital gains, when you do sell, are taxed at just 20% for long-term holdings, nearly half the top wage rate. Hold an asset for more than a year, and the tax code rewards you. The system has 2 lanes, and one is significantly faster. Here's where it gets strategic. Wealthy individuals use a method called buy, borrow, die. Step 1, buy assets that appreciate, stocks, real estate, art. Step 2, borrow against those assets when you need cash. Banks will lend you millions at low interest rates, using your portfolio as collateral. Loans aren't taxable income. You're spending money, but triggering no tax event. Step 3, hold until death. When you die, your heirs inherit those assets with what's called a stepped-up basis. Meanwhile, real estate investors use depreciation to create paper losses that offset real income. A $10 million apartment building can generate $300,000 in annual depreciation deductions. Then there's the 1031 exchange. Sell one property, buy another of equal or greater value within strict timelines, and defer all capital gains indefinitely. Beyond individual strategies, the wealthy build structures, legal entities that change how income flows and how taxes apply. Pass-through businesses like S-Corp and LLCs allow business income to flow directly to owners, avoiding corporate tax rates. Private equity managers benefit from carried interest treatment, where their share of investment profits is taxed as capital gains, not ordinary income. The qualified business income deduction lets many pass-through owners deduct 20% of their business income right off the top. Charitable giving offers another avenue. Donate appreciated stock directly to a charity or donor-advised fund, and you avoid capital gains entirely. A $1 million stock position that cost you $200,000 generates an $800,000 unrealized gain. Donate it, and you pay zero tax. Deduct $1 million. Private foundations take this further, allowing families to control philanthropic assets, employ relatives, and satisfy giving requirements at their own pace. Tax loss harvesting, selling losing positions to offset gains, keeps taxable income low in profitable years. The final layer is estate planning, moving wealth across generations with minimal tax friction. The federal estate tax exemption sits above $13 million per individual. Married couples can shield over $26 million. Amounts above that face a 40% estate tax, so high net worth families use tools like GRATs. You put assets into a GRAT, receive fixed payments for a term, and whatever appreciation remains passes to heirs tax-free. Annual exclusion gifts, currently $18,000 per recipient, let families move $72,000 per year to 4 children without touching lifetime exemptions. Municipal bonds generate interest that's exempt from federal income tax. For someone in the top bracket, a 4% muni yield is equivalent to a 6.7% taxable yield. All of these strategies require precision. That's why the wealthy employ armies of CPAs, tax attorneys, and wealth advisors. These strategies are legal by design. Congress wrote these provisions deliberately to encourage investment, support real estate markets, promote charitable giving. If the results feel unfair, the remedy is policy, not blame. The tax code reflects choices about what behavior to reward and what to discourage. Understand the rules, play by them, and push for the ones you believe in, because the gap between what's legal and what feels just is where the real debate lives.